Hey guys, Amna Nawaz here in New York. It is Friday, February 9th, and a lot of people are paying very close attention to the markets today after Dow took two major point drops just this week alone. A lot of wildness, a lot of volatility. ABC's Lindsey Janis is on the floor of the New York Stock Exchange. Try to explain to us what is going on here. Lindsey, let's just start off with how things look today.
Good morning, Amna. We've actually got the Dow up about 0.5%, 2/3 of a percentage point right now. Stocks opening higher after that massive sell-off yesterday. It is looking like it could be another volatile day. You said it, the Dow down more than 1,000 points on Thursday. That was the second biggest one-day point drop in history. The biggest was on Monday. You could see the shock and anguish in the faces of the traders down here on the floor. The stock's now officially in correction territory, which means they are down 10% from their all-time high. That was just 2 weeks ago on January 26th. Nearly $2.5 trillion in wealth wiped out in that time, Amna.
So, Lindsey, here's the thing a lot of people are confused about, right? They see that downward red arrow, they see the big numbers, and they say, hey, I thought the economy was doing really well. That's what I keep hearing about. So what does this mean? What's behind these numbers?
Yeah, ironically, the stock market here seems to be selling on good news. A lot of investors we've been speaking with say that this is actually about concern that the economy is doing so well. More people have jobs. Wage growth is moving higher. And so they're concerned that the Federal Reserve is going to have to hike interest rates at a faster than expected pace in order to kind of keep the economy from overheating. Rate hikes is how it pumps the brakes on the economy. So I actually want to bring in Keith Bliss from Catone and Company. He is a floor broker here, a trader at the stock exchange. Thanks for being with us, Keith.
My pleasure, Lindsey.
So what do you put the sell-off down to?
Well, a lot of what you were just talking about, we were in a situation where the market was trading at all-time highs. Whenever you get up to those levels, you can see it in the lack of volatility and the lack of volume, quite frankly, in the market. And it was on tenterhooks, so it was just waiting for that match to spark the bonfire. We got it, ironically enough, in good economic news, which was the jobs number a week ago today.
And specifically, that wage growth, the average American worker's wages higher in January, the fastest wage growth pace in 9 years?
That's right. So what's often not represented from the headline number are the underlying data points, and you cited the most germane one, which was the wage growth, and it was really the year-on-year wage growth, which came in at 2.9%. That's a little bit hotter than the Fed wanted, and a little bit hotter than most economists were guessing on or expanding on. And so what that did is that led to a downstream, almost a domino effect inside of the markets, where people think inflation is going to kick up, which means interest rates will have to be risen faster than people expect. And two things that the stock market does not like is inflation and a rising rate environment and a lack of corporate earnings. So people were getting ahead of this trade. And then there were some other technical factors inside of the market which really led to the sell-off.
But generally when interest rates rise, stocks can move in the opposite direction. Just try to explain for people. I mean, the stock market is kind of looking at what's going on, say, 8 to 10 months from now. It's not trading on the economy right now. It's looking into the future.
No, that's right. So nothing has changed. Other than the fact that the perception is that inflation will pick up. So the linkage between inflation and stock prices is if you have an overheating economy, then the Fed will raise interest rates, and thereby they will take money supply out of the marketplace. If you don't have as much liquidity in the market, then you don't have as much money for companies to go borrow against, expand their businesses, pay higher wages, and therefore they're not making as much money. And the stock market is a valuation on the discounted cash flows of future earnings of each company. And if investors and traders don't think they're going to earn more money in the future because of higher interest rates, then they will sell off those stocks.
We're talking about inflation. We're talking about the economy potentially overheating, or so that the Fed has to step in. How do the Trump tax cuts play into all of this?
Well, this is one thing that I think the market has to balance against. Financial conditions have been easy for a very long time, driven mostly by our own U.S. Federal Reserve Bank, but other monetary authorities around the globe. And now with the Trump tax cuts, we're going to have even more liquidity and more available cash for companies to expand their businesses,
pay workers
to the bottom
more.
line, pay workers more. The fear, though, is that, will those Trump tax cuts create an environment where the U.S. gets into a further debt situation, which we will. We all know that's going to happen, but how will that potentially crimp the economy going forward? Because even though we've been expanding our own borrowing and our own debt for many decades. This is not just an occurrence in the last 2 or 3 administrations, but for many decades. How will that impact our own economic outlook going forward? And people are starting to get fearful for that. People don't realize between noted and also intangible obligations, the U.S. owes somewhere in the order of intangible obligations, meaning Social Security and other things like that, somewhere in the order of $90 trillion.
And here you have this budget deal.
That's
and
right.
talk of raising the debt ceiling.
So the budget deal, they have to raise the debt ceiling. They're going to expand discretionary spending, particularly around the military, and that's just going to add on to the debt. So the real fear is, do you get at some point, do borrowers or investors just stop buying U.S. government paper, U.S. government bonds? And if that's the case, then of course that will be the worst of all scenarios for the U.S. economy.
So what does the average investor do right now? Someone that's sitting at home worrying about their 401k?
Well, certainly it depends on how old you are. If you're 65 years old and you're depending upon that money, you shouldn't be in stocks to begin with if you're that old. But if you're a 25-year-old and you're just starting out and you're putting money in the 401k, my perception and my thinking has always been put money in the stock market. It's always been the best return of any asset that you could possibly get your hands on, whether it's a commodity, a bond, again, an equity, cash instrument, any of the like. Right now, standing right here, the sell-off is so violent and so swift, unlike we've ever seen. We have, again, a technical term, I don't mean to do this, but the markets are vastly oversold at this point in time.
So you think it's a buying opportunity?
I do. So we work mostly with institutional investors, and we're the people that I've spoken to. I've essentially been saying this is one of your best opportunities that you've had in the last 2 years to go buy stocks that are deep value now, because the market participants basically threw the baby out with the bathwater. They sold everything. It didn't matter. Part of that was because retail investors were coming back to the mutual fund complexes and to the exchange-traded funds, and they were redeeming their shares, and therefore they had to raise cash. And when they do that, mutual fund complexes have to sell stocks to raise that cash to give the money back to the investor.
It sounds like you think this correction might be done.
Friday's going to be tough. Today's going to be tough, and the reason is because it's Friday. So any investor who's been nervous during the week, it's unlikely that they're going to come back in and buy on a Friday, because you never know what kind of news you're going to get on Saturday and Sunday from geopolitical land.
Right, and during the second worst week for the Dow during the worst week for the Dow since 2008.
That's right, and it's against human nature to have the courage to go in and buy when you think the world is coming to an end, so to speak. But people should be courageous and confident, and grab onto that anchor in the wind, because I think this is an excellent buying opportunity, and you could get some really good values on Dow names, big NASDAQ names, big S&P 500 names, and really have it turn out well. The selling pressure and the selling was too severe. It went too far the one way. It definitely should snap back. It may not happen today, but it will in the coming sessions.
And corrections are par for the course. We have corrections every so often. We've been in a 9-year bull market, correct?
That's right, but you got to remember, people forget it's been a 9-year bull market, but it hasn't gone straight up. The last time we had a pretty big sell-off was back in August of 2016, where the markets pulled back, and they're healthy. They're very healthy. They clear out some of the, it's almost, you think of it like a forest, catching on fire and clearing out all the dead wood. You clear out the weak hands, you right size your valuation, you change your perspective on where the market needs to be, you bring it back into more normalcy, you balance that against what's happening in the interest rate environment, and again, you go in and buy. Nothing fundamentally has changed. The U.S. economy is still doing well, relatively well, as opposed to the last 9 years. Monetary policy is still very accommodating. We're in the midst of first quarter earnings season, or fourth quarter earnings season rather, which by all accounts is excellent on both top line sales and bottom line revenue. So none of the fundamentals have changed. This was the mass sell-off, again, was because of interest rates. That was the spark, but then there were technical factors underneath the market which led to the tumbling that we're seeing this week.
Is it fair to say, though, that this is a whole new world, that the era of rock bottom interest rates may be over, and that this correction is part of kind of a wider reality check here?
Yeah, I mean, listen, it is true when you think that historically, the average federal funds rate, which is the rate that our U.S. Federal Reserve guides toward, historically that's been around 4%, and it's been on both a real and a nominal basis pegged to zero for a long, long time. And people forget that people forget that the market went into convulsions or spasms when we started entering into this very loose monetary policy or extraordinary monetary policy, whether it was around quantitative easing or the name that they came up with when they were buying bonds called Operation Twist. The market did not react very well to those things because we just couldn't see what was the end game out there and what it would mean. So as we come out of those extraordinary monetary policies, the market's going to spasm occasionally, and that's what you're seeing this week.
And when we see these photographs of you traders going like this and just looking like you're shocked and in anguish, I mean, it's obviously it's a different situation for every investor, but what are you guys feeling? What are the emotions you're going through on the floor?
Well, a lot of times those pictures are taken out of context. So they're not necessarily taking pictures of us who are in the broker booths dealing with the outside world and clients. You get a lot of the pictures of the specialist guys back here who are managing individual stocks and individual names, and maybe something's gone against them in a position, so that's why they may have that reaction. Or
they may have just lost a lot of money.
Or maybe they just didn't like the lunch that they bought. I don't know. It could be anything at that point.
Thank you very much for helping us put this in perspective. Keith Bliss from Catone & Company. Thanks very much.
My pleasure.
And Amna, just to put it into perspective even more, stock markets are still significantly higher than they were 1 year ago. So the average 401k investor is still looking at a gain of about 12% from a year ago. So the message is don't panic.
Don't panic for now. That is the word on this Friday. Lindsey Janis live there on the New York Stock Exchange floor. Thanks, Lindsey. Thanks to all of you for watching as well. Stay right here for your latest market news or head over to abcnews.com anytime. Better yet, download the ABC News app. We'll send all that information right to you. Thanks for watching. For now, I'm Amna Nawaz, and I'll see you back here soon.